You should already have an idea of what a break-even point is from other classes. This is when total sales equals total costs. The amount of money we are making is the same amount of money we are spending. There is no profit or loss. I always ask this question in class. Is breaking even a good thing or a bad thing? What do you think? It really could be either or. It depends on the circumstances. If this was your first year in business, where most companies will lose money, then this would be considered a good thing. Or even if we've had losses for several years and now we're breaking even, this would also be a good thing. But let's say you've had a steady profit over the last few years and now you're breaking even, then this would be a bad thing. It's really all relative to what's going on in the business. There are two formulas that pertain to the break even point. The first formula is to calculate the break-even point in units. This will tell us how many units we need to sell to break even. The formula is fixed cost divided by the contribution margin per unit. The second formula is the break-even point in dollars, which means sales dollars. This will tell us what our sales amount needs to be in order to break even. The formula for this is fixed costs divided by the contribution margin ratio. The margin of safety is the difference between your expected sales and your break-even point in sales. Think of this as your safety net. You want to be as far away from the break-even point as possible because that means you're making more of a profit. Calculating margin of safety is very easy. It is your sales minus your break-even point in the sales dollars. You can also turn this into a percent, which can be a more meaningful calculation usually. The margin of safety ratio is our margin of safety, which is the expected sales minus the break-even point. So this numerator could just be your margin of safety, divided by your expected sales. Once again, a higher number is better. Our last analysis is going to be the target net income. This is similar to the break-even point, whereas our target net income was $0 when calculating the break-even point, and here we will want to find a specific profit amount. The formulas are extremely similar. We will be able to calculate how many units we need to sell or what our sales dollars needs to be in order to achieve that specific net income. For example, I want to make $1 million this year in net income. What do my sales need to be to achieve that? Or how many units do I need to sell to achieve that? The first formula is to determine how many sales in units we need to sell in order to achieve our specific net income. We would add our fixed costs plus that target net income. In my example, it would be $1 million, divided by your contribution margin per unit. The second formula is to see what our sales in dollars needs to be in order to achieve that target net income. We would add fixed costs plus the target net income, then divide by the contribution margin ratio. These last few slides, we're going to bring all this information together. This is the CVP graph, and remember CVP stands for cost, volume, profit. This is just a visual of all the formulas you just calculated. Take a moment to look at this. At the bottom, we have the sales. On the side, we have dollars. Here's our fixed costs. Then we have our variable costs. Right? When you add them together, we get our total cost. This yellowish line right here, this is the sales line. The more units we sell, the more money we make. Where our sales and total cost meet, this is our break-even point. You can go across and look at the break-even point would be in dollars and what the break-even point would be in sales. Anything above that is our profit area, and we can also calculate our target net income from here. Anything below the break-even point would be a loss. Our last topic is taking a look at the income statement for a company that likes to do a CVP income statement, cost, volume, profit. Your net income would be the same regardless on what type of income statement you're using. We are just formatting it a little differently. What we're going to start with is showing the contribution margin. We take our sales minus the variable costs to equal our contribution margin. Then we will subtract all the rest of our costs, the fixed costs, to get our net income. This is what it looks like.